Now, typically during this time of the year, institutional participation is low. But yesterday something very interesting happened. FIIs pumped nearly 3,000 crores in the cash segment. Are we seeing FOMO playing out here, given that the kind of returns we have seen since late October?
Yeah, thank you. Good morning. And definitely there's some degree of FOMO. CFIs haven't been persistent buyers. If we look at the full year number, including yesterday's data, it's minus 22,000 crores. Now, of course, that's not as big as last year's minus 2,78,000 crores of outflow. And the reason for that is that on a monthly basis, we've had a couple of good months, during this year. One of them has been December. So that sort of, pulled us back into the green. In fact, March, April, May, June, these were positive months. And then you had negative months of August, September, October. And then again, November picked up and December's been pretty good. So we've had FIs come on and off, in and out of the market. And that is so that is why it's an unpredictable. But surely after the recent Fed announcements, we have seen some degree of FOMO money. Also because the dollar is consistently falling every day. I'm not really betting on the continuation of that trend because, like I said, they've been on and off. They came in for 4-5 months mid of this year, and again they went negative after August. Let's see what happens in January, because January is a critical month. The year end is over. So whatever money is being pumped in now is basically year-end allocation that may have been done even before the holidays and has to be completed. When the new year starts is where new allocations actually are done for the year ahead. And that can be very, very different. Jan, in a sense, also has a history of being more negative than positive. Out of the last 10 years, 7 years were negative returns and only 3 were positive returns, even though the average return is 0. And so it's not the best time to go all in. It's a very good time to take cognizance of where we are and really look for some downside and a better opportunity to buy the lows as and when that happens. So we really need to approach the new year with caution. But yeah, it's been a great year-end rally.
All right. Approach new year with caution. And so you rightly pointed out that January is in fact a period of lull for the Indian markets. But bringing back the focus on FIIs, do you think that the emphasis on their activity is disproportionately high? Because again, I was looking at the historical data of the past decade. It indicates that in 7 out of the 10 years, net FII activity in cash segment was negative. Yet the markets have rallied, and how? So do you think that we pay too much attention to what FIIs are doing?
To some extent, it is true. Historically, it has played a role because it was the only source of liquidity. Now, thanks to SIP becoming so widespread, I think since the mid 2015s when FII flows turned negative, SIP flows had turned positive by 5,000-6,000 crores, then 8,000. By COVID, and then after COVID, it's now gone to almost 15,000 crores a month of inflow. That sort of helped stabilize the situation in terms of their impact. But if I look at a lot of history, it's not always been correlated. So even if I go back 20 years, I remember when FII flows actually reached new highs in terms of positive flow, it was in the midst of the Y2K bear market, which is when stocks were actually crashing. And they were buying the most that they had ever bought at that point of time on a relative basis. Did that keep the bear market from going on? The answer is no. So we do pay too much attention on a day-to-day basis trying to predict why the market went up, and it's always hindsight analysis. For example, yesterday the market goes up, and at the end of the day, when you see a plus 3,000 crores, you say, this is why the market went up. But there are many days when market can fall and you can get a positive flow, and you cannot explain why the market fell if they were buying. We shouldn't. In my mind, we don't pay too much attention to the day-to-day flows in the cash market. We do pay a lot of attention to the position that participants, FIIs, DIs, and client side have in the futures market, specifically the index futures, and that tells us the sentiment at any point of time. And right now, if we talk of sentiment, it is at an extreme because you have large long positions by FIs and probably the highest short position since 2017 on the client side.
But do you think that the heavyweights are now playing a catch-up, because the big one, the Nifty Bank Index, has only started participating now, And heavyweights, although they have rallied, they are significantly, a fair distance away at least from their all-time high levels.
No, surely, and this whole discussion about FII flows plays a role there because most of their buying ends up being in large caps because it's very macro allocation. The way global funds allocate is they're either linked to an MSCI EM index or some kind of a model where you say, okay, I need to allocate to emerging markets. India is this percentage of that, and so much money comes into India, and usually those indices have a lot of large caps built into them. So large caps is where most of the money goes. So moment you got a positive month on institutional flow, that means the large caps start participating. So that is sort of what we have seen.
All right. Now, sir, India VIX, now that has seen a sharp spike in the last couple of weeks. We were at about 11 levels or so. Now we are at a 9-month high above the 16 sort of levels. What does that indicate, and is that going to be a cause of worry for investors?
It is definitely a cause of worry. I mean, the last time you saw this happen was at the October 2021 peak. So in the month of October, in 21, where the market, topped out at 18,600, then it stayed below that for almost 8 months, I think almost a year in terms of time taken, but it was falling for the next 6 to 9 months. At that time, the India VIX had also moved up while the market was rising, and then eventually the market gave up. I think we have a very similar situation here because the rising India VIX is not because of event risk. Usually, if you have an event like if this month you had elections or this month you had a big policy meeting or something like that, which the market was pricing in, then usually after the event, the IVs come down and then it stops having an impact. But here you're seeing IVs go up not because of any event risk, it's because of market behavior. And that is usually a negative divergence when VIX and equities are rising together. It's also, and what this also signals is the exuberance itself. Question people are asking is why is the VIX going up? The answer is very simple. VIX is related to the premiums that you pay in the options market, which means you're willing to pay a higher and higher premium to buy calls or puts. And these premiums are directly linked to the futures premium as well. The Nifty futures or the stock futures is what determines. So if the stock future premiums go up, it pushes the options premiums also higher. So we are seeing the highest index premiums also, which is the Nifty spot to futures difference at over almost 200 points for the January series is one of the highest on record. And therefore, that itself indicates excessive bullish sentiment in the market. That bullish sentiment is expressed in higher premiums, which is what the VIX is really telling you. So it's sort of telling you that people are over bullish. It is a risk, as in when the market reverses course from here, that excessive bullishness will unwind and cause some kind of a knee-jerk reaction, which is what I think Jan 2024 can bring.
And talking about market reversing its course, do you think we are right there? Because market does look overbought, and January typically is a muted month for us. Do you think we can see a pivot from here?
So January is not a muted month. It is a very heavy month on either side. Like I mentioned, it's either down or it's up big. And 7 out of 10 years was negative.
Right, right.
And only 3 years were positive, and those 3 positive years were also pretty big months. So January does see a lot of movement. And yes, so that does put us at a point where a reversal from up to down could actually give you a very sharp move to the downside, as and when it happens, except that you need to wait for it because seasonally markets don't always top out in December. So if they had to, they would have done so in the first week of December. Now that we've extended, usually you will see the all-time highs continue into the first week of January. So I would think the final peak is only made on, say, Monday after New Year's rather than today or tomorrow. So we may continue to see the market trying to extend higher as it has done today and even into tomorrow, and only finally see the peak sometime next week. That is how we'll look at it.
So, Mr. Srivastava, would you advise investors, and I'm talking specifically about them because high VIX is a playground for traders, would you advise them to take some money off the table now?
Yes, definitely. That's been my communication that each one on his own, but you need to raise your risk levels by raising your cash levels, which means you should create some cushion based on what you perceive as the downside risk. And as you get more confirmation, you can increase that, but at least start with something. And each one can have his own percentage based on what risk appetite they really have. But definitely, this is a time when its exuberance is when you can actually sell very easily. If you try selling stocks, probably it'll be easier when everybody's buying
Hmm.
than if you try selling when everybody's trying to sell. So it's always a
Right.
good thing to book gains. You don't always get the opportunity to do that at the highest levels.
All right. And Mr. Srivastava, before we let you go, we are like 2023 pretty much was a year of for PSUs. Various sectors performed there, realty as well. Stepping into 2024, what sectors particularly could one look at to add to the portfolios?
So some of the sectors that have done well usually continue to do well. Now, if you do get a difficult market, I would say pharma would be a saving grace because the pharma sector actually didn't participate except for the first part of the COVID rally. And then after that, they went into a long, deep correction. And now they're actually picking up. So there's a very much a possibility of outperformance in pharma in a difficult market. But let's presume, okay, you get a giant correction and the market is not so difficult, it picks up again. If there's positive momentum, then you actually go back to the strongest sectors, which means everything from a PSU to what you're seeing right now in metals. Coming back most of 23, actually, we didn't see very great strength in metals. Only in the last month, we've seen them pick up. It may be an early sign that the metals are making a comeback. So if we do get that pullback, metals may be one place to revisit, from a longer term standpoint where they may be starting a fresh cycle to the upside. So these could be two sectors I can think of. Banking, of course, is another which is significantly underperformed and can actually play catch up in a big way.